Hey traders, welcome back to the Forex Muse. Today we're tackling one of the most exciting and game-changing topics for any trader: how to build a successful trading strategy from scratch. Whether you're a complete beginner or someone who's been dabbling in the markets but hasn't quite nailed down a consistent approach, this video is for you. We're going deep, breaking down the 5 essential components that every winning trading strategy needs. By the end of this, you'll have a clear roadmap to start crafting your own profitable plan. So grab a coffee, get comfortable, and let's dive in. Before we jump into the nitty-gritty, let's set the stage. Have you ever wondered how professional traders seem to make money while others are left scratching their heads? It's not luck, and it's definitely not a secret sauce. It's all about having a strategy, a structured, repeatable plan that guides your every move in the market. Today, I'm going to walk you through the 5 key building blocks of that plan: direction, setups, confirmation, entry, and risk management. These are the pillars that'll turn your trading from a guessing game into a calculated process. Ready? Let's dive in and make this fun and easy to follow. First things first, before you trade, you need to figure out which way the market is moving. Imagine you're about to swim across a river. Would you jump in without knowing which way the current's flowing? Probably not, unless you enjoy a good struggle. In trading, direction is all about spotting the market's flow. Is it heading up, down, or just drifting sideways? This sets the tone for everything else. An uptrend is when prices keep climbing over time, like a staircase going up. You'd notice the price hitting higher peaks and higher valleys. A downtrend is the opposite. Prices are sliding lower, making lower peaks and valleys. If it's bouncing back and forth without a clear path, that's a sideways market, and you might want to hold off or switch tactics. How do you figure this out? Look at the bigger picture of price movement over time. Imagine the price moving downward and rejecting a daily or weekly level, say a strong support or resistance it's hit before. Then giving a breakout on the 4-hour time frame to indicate a change of direction. For example, if the price drops, test that key level, and then give a 4-hour breakout, it might signal the downtrend's flipping to an uptrend. The trick? Trade with the flow. Going with the trend is like swimming with the river's current. It's smoother and gives you a better shot at success. All right, now that you've got the direction, it's time for setups. This is where the fun begins. A setup is a specific pattern or condition in the market that screams, "Hey, there's a potential trade here." Think of it like fishing. You're waiting for the perfect moment to cast your line. For example, let's say we're in an uptrend. A classic setup might be a pullback, where the price temporarily dips back to a support level, like it's catching its breath before continuing its climb. Picture a runner slowing down for a sip of water before sprinting again. That's your chance to jump in. Another powerful setup is price rejection on a higher key level. Imagine the price surging up to a significant barrier, like a ceiling it's hit before, only to get smacked back down with a sharp reversal. That rejection candle with a long tail showing buyers or sellers got overpowered screams opportunity. It's like the market saying, "Nope, not breaking through yet." Another option is a breakout, where the price suddenly surges forward with extra energy, like a car breaking free from traffic. The key is patience. Match your setup to the direction. If the market's rising, look for buying opportunities. Don't rush in just because you're excited. Wait for the market to signal it's ready, like waiting for that tug on your fishing line. Good things come to those who wait. But hold up, don't jump in just yet. Seeing a setup is great, but you need confirmation to make sure it's the real deal. This is your safety net, the extra evidence that says, "Yup, this trade's got potential." Without confirmation, you're basically guessing. And trust me, I've learned the hard way that guessing doesn't pay the bills. Confirmation can come in different ways. Maybe it's a candlestick pattern, like a bullish engulfing candle that shows buyers are stepping in. Or perhaps it's an indicator, like the RSI moving out of oversold territory. Whatever it is, it's your green light to proceed. Personally, I've rushed into trades without waiting for confirmation before, and let's just say it wasn't pretty. Patience here can save you a lot of heartache. This step is all about confidence. It's the difference between guessing and knowing. Wait for that green light, and you'll avoid a lot of unnecessary bumps down the road. Now that your setup's confirmed, it's go time. Entry. This is the exact moment you pull the trigger and enter the trade. Timing matters here. Enter too early and you might get faked out. Enter too late and you could miss the move. The goal is precision. You've got options for your entry. Some traders go for it right after confirmation, like the second that green candle finishes forming. Others might wait for the price to break above a key level to be extra sure the momentum's kicking in. You could even set a plan to buy if the price dips slightly again, snagging a better deal. Whichever you choose, make it a rule. Having a clear entry plan keeps you from second-guessing yourself when the market's moving fast. Last but definitely not least, risk management. And honestly, this might be the most important step of all. This is your safety net, and it's what keeps you in the game even when trades don't pan out. Even the best setups can fail sometimes, and without a solid risk plan, one bad trade can wipe out your account. Risk management is your shield. First, start with a stop loss, your emergency exit. It's a price where you'll bail out if things go south. For a buy trade, set it just below a recent low point, somewhere that, if reached, shows your idea didn't work. Next, think about position sizing. How much are you betting? A smart rule is to risk only 1 to 2% of your account per trade. Got $10,000? That's $200 at stake. Adjust your trade size so a stop loss hit doesn't cost more than that. Bonus tip, set a profit target. Aim for a win that's 2 or 3 times your risk, like risking $100 to make $200 or $300. It's like planning your victory dance before the show starts. Risk management isn't flashy, but it's the secret sauce that keeps pros profitable. So, let's recap. You spot the direction, the market's climbing. You find a setup, maybe a pullback during that climb. You wait for confirmation, a strong green candle. You pick your entry right after that signal, and you lock it in with risk management, a stop loss, and smart sizing. That's your strategy, built from the ground up. Building a strategy takes practice. Don't expect to nail it overnight. Start small. Test it on a demo account or with tiny positions and tweak it as you go. What setups work best for you? Where do you set your stops? And see what clicks for you. Trading's a journey, and this is your roadmap. That's it, folks. The 5 key components of a successful trading strategy: direction, setups, confirmation, entry, and risk management. If you take one thing away from this, let it be this. Trading isn't about gambling. It's about having a plan and sticking to it. What do you think? Have you ever tried building your own strategy? Drop a comment below. I'd love to hear about your experiences or any questions you've got. If you enjoyed this video, smash that like button, hit subscribe, and ring the bell so you don't miss more trading tips like this. Thanks for watching, and I'll see you in the next one. Happy trading.